So, let's break down how professional traders actually see a chart. And I mean really see it. This isn't about memorizing a bunch of simple patterns. It's about understanding the very skeleton of price action itself. And to do that, we're going to use the incredible framework from master trader Moneytaur as our guide.
You've probably heard this statistic before, right? It's pretty brutal. 9 out of 10 people who start trading just end up losing money. So, why? What is going on here? Is it all just random chaos, or is there something fundamental that almost everyone is getting wrong?
Well, here's the absolute core of the problem. You see, retail traders and professional traders, they're playing two totally different games on the very same field. Retail logic is all about reacting, chasing breakouts, buying the hype. But pro logic, it's all about anticipating. See, pros know that the lines on a chart don't actually move the price. The real engine of the market is the constant hunt for liquidity. That's the fuel, and it's the only thing that matters for big moves.
Okay, so if you want to start thinking like a pro, we've got to go right back to square one. I mean, the absolute basics. Everything we're about to get into is built on this one simple foundation: being able to correctly identify the trend.
And you know, what's key here is how simple this really is. On the left, you've got a bullish trend. It's just a clean series of higher highs and higher lows. And on the right, a bearish trend is just the opposite: lower highs and lower lows. That's it. This is the market's heartbeat. Getting this rhythm down is the very first step to being able to read the story the chart is trying to tell you.
And here it is, the secret ingredient: liquidity. Just think of it like gas for a car. It's the fuel for the market. So where do you find this fuel? Well, it's clustered in pools of buy and sell orders, especially all those stop losses that retail traders place just above the highs and just below the lows. Price isn't just wandering around randomly. It's an intelligent predator, constantly hunting for these pools of orders so it can power its next big move. To put it simply, price follows the fuel.
All right, now let's zoom out a bit. We're going to move from looking at individual trends to the entire market cycle. Because, just like the seasons change, markets move through 4 very distinct and, believe it or not, predictable phases.
And this visual just lays it out perfectly. The whole thing kicks off with accumulation. This is where the smart money is quietly buying everything up when no one's paying attention. Then, boom, you get the markup. That's the bull run that gets everyone on social media excited. That leads to distribution, where the smart money starts selling their bags to that euphoric crowd. And finally, you get the markdown, the bear market, the crash. And this whole cycle, it just repeats over and over again on every time frame. Now, this is where it gets really interesting. Each one of these technical phases is driven by human emotion, and it's often manipulated on purpose. Think about it. During accumulation, the news is awful. Everyone's either scared or bored. Then, as the markup starts, optimism slowly trickles in. By the time we hit the distribution top, the media is shouting from the rooftops about new all-time highs, fueling pure greed right as the insiders are cashing out. And of course, the markdown is driven by absolute panic, with headlines confirming everyone's worst fears were right all along.
And Moneytaur just nails it with this quote. I mean, think about that. Your own feelings, that feeling of intense greed or that gut-wrenching fear, are often the most powerful indicators you can possibly find. You just have to learn to see them as the opposite signal. The market is basically engineered to make you feel the exact wrong emotion at the exact wrong time.
Okay, so we get the big picture, the cycle. But how do we actually spot these turning points in real time on a chart? Let's dive into the specific signals that tell us a trend might be running out of steam or about to reverse completely.
First up is what we call a BOS, or a break of structure. It's super simple. In an uptrend, it's when the price makes a new higher high. In a downtrend, it's a new lower low. A BOS is just the market giving you a thumbs up, confirming, yep, this trend is still healthy and strong.
Now, listen up, because this one's a big deal. A CHACH, which stands for change of character, is your first warning flare that a reversal might be coming. So picture an uptrend. Higher highs, higher lows, everything looks great. Then, all of a sudden, price fails to make a new high, and instead it comes down and breaks the last higher low. That's your CHACH. It's the market whispering to you that its personality is starting to change. And finally, you've got the bombs, the break of market structure. This is the big one. This is the final confirmation. It's a clean, decisive, powerful break of a major structural point, usually one you'd see on a higher time frame chart. When you see a bombs, it's not a warning anymore. It's a clear statement that the market's overall intention has officially flipped.
This little diagram just ties it all together so well. You can see the series of boss moves, confirming that uptrend. Then you see the first sign of trouble,
the chotch, as a key low gets taken out. And finally, the big confirmation, the bums, as the major low that started the whole move up gets violated. This sequence tells the complete story of a trend dying and a new one being born.
Okay, this might be the most important role of this whole thing, so really let this sink in. How do we confirm these bricks? A long wick that just pokes through a level means absolutely nothing. In fact, that's usually just manipulation, a stop hunt designed to grab liquidity and trick people. For a break to be real, for it to be confirmed, you need to see the candle body close past that level. Remember, wicks are just noise, wicks can lie. The body of the candle shows commitment. The body is the truth.
All right, we've laid all the groundwork, and now we get to the fun part. We can finally look at a specific, high-probability setup that Moneytaur calls the squiggle. This is how you put all this knowledge together to avoid those classic retail traps.
The system is so simple, but it does require one thing: patience. So, step 1, you wait for a confirmed break of structure, a body close, and you do not chase it. Step 2, you just patiently wait for the price to pull back, to retrace into a key area where it left some fuel behind. And then, step 3, you enter on that pullback, which puts you in a great position to ride the next wave in the direction of the trend.
And this chart is a textbook example of a bearish squiggle. So look, you can see step 1, a confirmed body close below support. All the retail traders are jumping in, shorting the breakdown, but the pro waits. Step 2, price pulls right back up into a key level, stopping out all those early shorts. And then step 3, the pro enters their short on that pullback, getting a way better price and a much safer trade as the downtrend continues.
This quote from Moneytour just says it all, doesn't it? Chasing the breakout is the obvious move. It's what everyone does. And because it's the obvious move, the game is literally designed to punish it. It's engineered to take the breakout trader's money and use it as fuel before finally moving in the direction they expected in the first place.
And just to prove this isn't some one-hit wonder, look at this. The pattern repeats over and over and over again. You get a break, a pullback, and then the continuation. Another break, another pullback, another continuation. This is the natural breathing rhythm of a healthy, trending market. It just goes to show that patience doesn't just pay off once, it pays off consistently.
So look, if you only take one single thing away from all this, please let it be this. The goal here is to completely shift your perspective. You have to stop just watching the price wiggle up and down on the screen. You need to start looking at the chart and asking yourself a different question. Where is the fuel? Where's the pool of liquidity that the market needs to hunt before it can make its next real move? And that really leaves us with one final question for you to think about next time you open up a chart. Are you going to keep chasing the price, being the fuel for somebody else's trade? Or are you ready to start thinking and acting like a hunter?